Hello, welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we unpack the key developments shaping credit, explore the macroeconomic forces at play, and dive into the strategies that matter most for investors across Europe and the UK. In today's episode, we take a look at what comes next for the French government, unpack recent changes in the UK political landscape, and as we navigate through the Munich Auto Show, explore the mounting challenges facing Europe's auto sector. Let's kick things off with France, again, as we did last week. As predicted, the vote of no confidence in Prime Minister François Bayrou resulted in the collapse of the government. But this isn't a full shutdown or a call for new elections. Instead, President Macron is expected to appoint a new prime minister who will attempt to assemble a new government and try again. In short, the path ahead looks like more of the same, really, muddling through. Bayrou had proposed 44 billion euros in spending cuts and tax hikes aimed at reducing the deficit from 5.4% to 4.6%, still shy of EU targets, but meanwhile, France's debt-to-GDP ratio has climbed above 115%. Markets are still holding relatively steady. OAT bond spreads have narrowed slightly, now at around 91 basis points as of Tuesday, down from a recent peak near 100. CDS spreads are down as well, currently at 37 basis points after hitting 40.5 earlier in the month. So, where do we go from here? Well, all eyes are now on Christine Lagarde and the European Central Bank, who speak on Thursday, where they are expected to keep rates steady. While no one expects a whatever it takes moment, as per Mario Draghi, France's fiscal outlook will need to be addressed if policymakers hope to maintain market confidence. Still, it's hard to see a clean resolution. Marine Le Pen, head of the National Rally, has already threatened to bring down any future prime minister until new elections are called. Until there's more certainty around France's budget path, we expect that bond markets should remain cautious and spreads to stay relatively wide. Now, turning to the UK, where politics continue to weigh on market dynamics, the government has finally set a budget date, November 24th. That's cutting it a bit close to the end of the year. Markets would clearly prefer it to have been brought forward, which would give it more certainty. But in the meantime, we could see renewed pressure from bond vigilantes as investors look for clarity on how the UK plans to address its fiscal gap. Angela Rayner's resignation triggered a cabinet reshuffle, giving Rachel Reeves a bit more breathing room as she works to scale back some of the more ambitious plans that have been floated by various ministers. Despite the political noise, gilts have found some relief. The 30-year yield has come down from 5.75% to below 5.5% as of Tuesday morning. Interestingly, despite fiscal concerns in both France and the UK, demand for government bonds remains remarkably strong. The European Union recently issued a €6 billion 30-year bond this week that saw a staggering €98 billion in orders. That's more than 16 times oversubscribed. Even in the UK, the latest government auction, this one for a 2043 bond, attracted strong demand with a bid-to-cover ratio of 3.5 times. According to a survey by 24 Asset Management, 80% of institutional investors say that at current yields, bonds look attractive relative to other asset classes, and we agree. So how does that translate to the broader issuance picture? Well, as of September 9th, European bond issuance is up 7% year over year. Investment-grade issuance in euros is also up 7%, while high-yield issuance in Europe has climbed 23%, and more than 50% if you focus specifically on deals denominated in European currencies. The laggards are in sterling-denominated investment-grade bonds, which are down nearly 8%, and in leveraged loans down just under 4%. But that decline in loans is off the back of an extremely strong 2024. So far this year, volumes have already surpassed the next strongest years, including 2021 and 2017. So leveraged loans continue to solicit strong demand. Sterling corporates had a solid year in 2024 as well, but still remain well below the pace seen in prior years. Overall, we don't expect the pipeline to slow down as we head into year-end. With bonds continuing to look attractive and with investor sentiment gradually turning more bullish, we could be looking at a strong finish to 2025 from an issuance perspective. Now, shifting gears, this week's Munich Auto Show has brought renewed attention to the auto sector, and not all of it is positive. Just ahead of the event, KPMG released its 25th annual Global Automotive Executive Survey, and the findings were sobering. Fewer than 1 in 3 European auto executives feel confident about achieving profitable growth over the next 5 years. This isn't just pessimism, it reflects a real collision between evolving consumer expectations, fierce global competition, and increasingly fragile supply chains. On the sales side, the transition to electric vehicles continues, but slowly. European automakers now expect battery electric vehicles to make up about 30% of new car sales by 2030. Problem: profitability remains elusive. Chinese automakers, particularly BYD, are entering the market aggressively. BYD plans to open 2,000 dealerships in Europe by 2026, double its model offerings, and localize all production by 2028. On the other side of the Atlantic, US manufacturers are benefiting from government protection. European OEMs are stuck in the middle, overregulated at home and undercut abroad. In response, industry leaders are lobbying Brussels to slow the pace of the electric transition. This week, major European automakers are meeting with Commission President Ursula von der Leyen to push for a more flexible timeline, arguing that more time is needed to compete with Chinese EVs and to reconfigure supply chains in response to US market tariff constraints. Meanwhile, European consumers are shifting away from traditional brand loyalty. Performance, digital experience, and vehicle connectivity are taking precedence. As a result, direct-to-consumer and online sales models are gaining traction. The old dealership model may not have much time left. On the manufacturing side, challenges abound. Executives continue to cite geopolitical risk, soaring raw material costs, and semiconductor shortages as top concerns. Nearly half say they're very worried about access to critical materials in the years ahead. That's driving a move towards nearshoring, dual sourcing, and investment in AI-driven manufacturing. But while 86% of firms are investing in AI and automation, only 20% feel truly prepared for the digital shift. And there's the added dimension of cybersecurity. As vehicles become rolling data centers, 7 in 10 European executives now consider digital threats a significant risk. So where does that leave us? KPMG's survey suggests a widening divide. A handful of leading firms are pulling ahead by embracing customer-centric design, regionalized supply chains, and digital-first operations. But the majority are still struggling to adapt, and risks remain high. This brings us to the broader transition facing the European economy. From a credit perspective, we could be on the cusp of a meaningful uptick in capital expenditure heading into 2026. That could be the catalyst that supports a continuation of the current bond and equity rally. Yes, trade disruption and the squeeze on consumers could create headwinds, but disruption also means realignment, and that means investment. Companies will need to spend to reconfigure supply chains, adapt to the energy transition, and upgrade infrastructure. Across Europe, we're already seeing stimulus in motion, whether it's infrastructure investment in Germany, defense spending across member states, or tax incentives tied to decarbonization. Layer on top the capital expenditure required to integrate AI, and the result is a wave of stimulus-driven activity. Importantly, European markets still trade at more attractive levels compared to the US. The New Zealand Sovereign Wealth Fund recently cited Europe as their preferred region for investment outperformance over the next several years. Now, of course, there's a caveat, and it's a big one. Much of this investment depends on government support. Most European governments, aside from a few exceptions, are still facing fiscal constraints. Add to that the continued underperformance from the European Commission in delivering structural reforms, and the picture becomes more complicated. As Mario Draghi recently noted in a speech in Italy, the EU still has work to do if it hopes to secure long-term growth. So, where does that leave us today? We appear to be entering a more bullish phase for markets. After months of reluctance, investors are beginning to capitulate and make the case for further gains, despite high valuations. Risks are still on the radar, but credit remains one of the most compelling opportunities, particularly in corporate credit and sovereigns, where yields remain elevated and demand is strong. That's it for this edition of the Credit Compass. If you enjoyed today's episode, don't forget to follow, rate, and share. And if there's a topic you'd like us to cover, please drop us a line. We'd love to hear from you. For deeper research and credit ratings, visit KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.